Welcome everyone to a review of the answers to the test review, getting you ready for test number 2 and covering back the topics we've covered since our last test. We're going to flip back and forth between the test review paper that you should have seen as earlier and the answers in a Google Docs or Excel document, or Excel spreadsheet. So first thing we need to do is take and apply the new revenue recognition model. And remember, the revenue recognition model has 5 steps. First of all, you determine there's a contract. And we'll assume that this does constitute a contract. And then you choose or identify the performance obligations. And we're going to see here that there should be 2 performance obligations, the mixer and the warranty, separated because they do sell them separate. So we're going to separate those into 2 performance obligations. Then we identify the selling price. That is going to take a little calculation because we have to consider the most likely scenario, which includes some form of discount. So on our spreadsheet, we're going to say that there's a 5% discount has a 40% probability. Multiply those out and get $1. Okay, 5% of our situation is $2.50 discount. So $2.50 times 0.4 or 40% is $1. And then there's a 10% chance that you'll get they'll take a 20% chance they'll take a 10% discount, which of course is $5 on the $50 mixers times 20. So each of those is $1. The third possibility is 0. So you multiply 0 times 40%, and of course you get 0. And you add up the probabilities, you get $2. That's your discount amount. So the actual price is $48 for this contract. That's the third step. We'll use that here in a minute. Fourth step, allocate between the purchase price or the sales price between the performance obligations. And we have 2 performance obligations, so we take that $48. And looking at the standalone prices of 50 and 10, we determine that 50 with everything included, 10 or $40 without the warranty, giving the warranty value of 10. So it's a 20-80 split. If you look at the standalone prices, 20% of it is for the warranty, 80% of it is for the actual mixer, and then we actually record the revenue. So the answer, the journal entry would be debit cash for $5,000. That's $50 times 100 mixers. We're going to plan on paying $200 in discounts as we go forward on those items because of our 100 mixers times $2 we calculated earlier. And then we're going to take 80% of the remaining $4,800 and recognize that as revenue at the sale of the mixer. The other $960 or 20% is allocated to the warranty, and that will be unearned revenue because we haven't done anything yet. And every month for the time period that we're going to do this, which is 12 months, we're going to earn $80 of that unearned revenue of the warranty revenue. So that's how those journal entries should play out to answer those questions. All right, we're given there. So if we move down to the next one, we're going to buy. Brown is buying cow division and then make it a part of their business. It'll stay somewhat independent within the holding company. So as we do that, we're going to look at the journal entry to record the purchase first. We record the $50 million in cash. We debit the assets and the remaining amount is goodwill. We debit assets for their fair value when we buy them from others. And so you see what they should all be recorded for. Then fast forward a few years, and some of those values have changed. Cash is a different amount. Accounts receivable has changed. Inventory was given to you. We calculate depreciation on the building. So this is the net value of the building left to depreciate. Equipment, same thing, using the useful life given, 3.5 years. We take a depreciation, building for 3.5 years, patent for 3.5 years over a life of 15. So while we recorded it originally at 14, now it's at 10.7 because of amortization is the term we usually call it. Goodwill is not amortized. It does not depreciate. It's still the amount we originally recorded. And then we had liabilities of $4 million, just over $4 million. So with all those added up, subtract the liabilities, all the assets minus the liabilities, net assets with the goodwill and the patent before any impairment is 43.7. But we have some information that the patent is probably, things have changed and we need to test for impairment. Patent is an amortizable intangible and therefore it needs to be tested for impairment when things change. We do so, we decide that it is impaired and that it needs to be adjusted to its fair value using the present value of the future cash flows. The only future cash flows are $2 million 3 times. We use the present value at 8% and we get a $5 million. You can see that there was quite the loss on the patent impairment from the original 10.7 down to 5.1. All right. Now we also need to consider the issue with goodwill. Is it also impaired? Remember, because it's not an amortizable intangible, it must be tested every year, regardless if anything has changed, for impairment. And so we're going to do that. We're going to look at the assets without the patent and the goodwill. So the rest of the assets have all been properly accounted for, so we add them up. We noted in our problem that other companies are trading or have a value that's more than their net assets. And if we average those 3 companies together, we get 1.47 or 1.466666, okay? When we look at that, we say, okay, then those companies are worth their net assets plus some extra amount, okay? Some extra amount. So that extra amount is 0.46. We're going to take our net assets, multiply with the impaired patent, not this number, but this number, but with no goodwill. The other assets the same, subtract the liabilities, and then we're going to multiply it by 0.46666. And we'll see that it's worth about 10,911,000 above our net assets. So this company should be worth about $11 million above the net assets, but goodwill says that we're worth 14.8 above the net assets. So we cannot record 14.8 when all of the goodwill that we have left is 10.9 based on this little valuation based on comparison to other companies. So the difference is 3.8. That's an impairment of goodwill because the future cash flows are not going to be what we thought it was when we bought this company in the first place. So that's how you look at impairment in both a patent and goodwill. Problem 3 is LIFO, and we have our usual calculations. The cost in this column, the sales price in this column. We're using the LIFO method, so when we calculate the gross profit percentage, we are using the 833,000 divided by the total of just the two. We don't include the beginning balances. All right, and that gets us just under 65%. These other numbers were given to us. This is all of it. Okay, this is your mark ups, but this is your mark downs. Okay, and then we subtract sales, and we get our ending inventory at retail of 229. Divide by 1.033 to get it without inflation. Compare this to our original without at retail, and get a new layer of 19,330, which we then multiply by, because we're using dollar value retail and dollar value LIFO, we are going to multiply it by the percentage and the inflation. Okay, so that's how we get the 19 to 12,887. We take that 12,887, that's our new layer. We add it to the original 147 as a new layer and get 159,887. Same thing happens in the next year. Very similar percentage, and we would expect that to be the case. We ended up with 397. Divide by 109. Take our comparison, compare it to the last time right after we divided. We see we have a new layer of inventory at retail, 141. This difference between the 2 years. That is going to be then multiplied by the percentage we got, the cost percentage, and the inflation factor, right, to get the 99,461. We add that to last year's inventory, and we're up to 259. Okay, last year, we're going to do the same thing. Okay, divide 101 by the total of these two, get our percentage. Okay, subtract our markdowns, add our markups, subtract our markdowns, subtract our sales, get our ending inventory at retail, divide by the inflation rate, and then we find that there must have been a LIFO liquidation because this year is lower than the year before. So no new layer. So we have to go back to our previous number right here, 222, and we see that yes, indeed, we have liquidated part of this layer, but we have not gone past here. We're still above that number. So then we compare the two. We get the difference of 48,652. That is the layer of inventory that is left. We're going to take that and multiply back to last year. We're going to multiply it by this percentage and this inflation rate, because this is a second year layer, not a third year layer. No new layer was added here. In fact, we sold part of our second year layer, but some of it is still there. So this is the tricky part, is going back, realizing you do not use this 1.12, you do not use the 64.27, you use back the year before, which of course was almost identical, but in real, we just need to make sure we do it correctly, because there may be a difference in real life. We then add that, not to here, because we're actually below that number, add it back to our ending inventory at cost from the year before that, because that's the layer we're in. So, and then the calculations for beginning net purchases, sales, gross profit, and gross margin for all 3 years, given the work we did above. And finally, problem 4. Has to do with impairment of loans. We have Tiger with some trouble, has 3 loans, one from A, B, and C. So looking at the loans as they see from A, B, and C, remember banks can only have losses on loans, not gains. So we see that Bank A, this is the carrying amount for Bank A, Bank C, B, and C. This is the fair value, because every one of them is impaired, because there's been a change in the terms. The fair value for Bank B is the collateral that they're going to receive in collection for that. This is the present value of the future payments at the current interest rate for both of them. Our losses at Bank A would be the difference between these two, Bank B between these two, and the loss between these two for Bank C. All of those will be recorded as losses, credit to the receivable, debit loss. Now for Tiger, the journal entries aren't going to look the mirror image. Okay, so when Tiger looks at the first loan to Bank A, they look at simply the $2,900. It's going to be the future payments times 120. So first thing you do is to test it to see if there is a trouble debt restructuring. The total cash to be paid is $348. That's less than the carrying amount, $441. So the gain is going to be the difference between $348 and $441 for Tiger, and that is going to be recorded as a gain. And each payment after that for the $2,900 will be all principal, no interest. So that answers the second part of the problem as well. For the Bank C, we see that the future cash flows are more than the carrying amount. So there is no gain for Tiger on the loan with Bank C. They would not record a gain. They would simply record interest going forward at a rate that makes the present value of these future payments equal to $109,000, which is the carrying amount. So you put in your present value formula. The amount is payment amount is 103. Number of payments is 120, and you just keep putting in different interest rates until you get the amount that it makes it equal to 109,000. For Bank B, for Tiger, you have a gain because you're actually going to give the bank an asset that we have recorded at 94,625, and it's going to pay off a loan in total for 139,000. So the gain is going to be the difference between those two numbers recorded, because we're going to exchange those two. All right, so you would credit the asset, debit the loan, and the difference would be the gain recorded. So that's how you would answer those test review questions.